We've got a lot of stuff to get through today, and with that, I think I will turn it over to Mr. Helms.
Thanks, Allison, and thanks everyone for coming or logging in. This is our August webinar, Director's Cut. I usually try to come up with a theme. This month's theme is hot weather, hot production, I guess. The weather is hot out there, and production, really not to anyone's surprise, but we hit the second highest oil production rate ever in the state of North Dakota, 1.211 million. So the only month that exceeded that was December of 14, which seems like a long time ago, but it's really not all that far in the past. We also finally surpassed 10,000 wells in the Bakken and Three Forks, and we've been working, easing up on that number for quite some time. But we now have over 10,000 wells producing from the Bakken and Three Forks formations. That amounts to about 1/6, we think, of the ultimate drilling potential in the formation based on what we know today, which is future increased density drilling. Some other positive numbers. Weather was great in June. We had very little interference, a couple of rainstorms that slowed things down, one in the Williston and one in the, I think it was in the Dickinson area or Minot area. But June generally is a good month for weather. We also had a large surge in June and July in permitting. And so at that point in time, we were seeing oil prices increase, and companies were pretty optimistic that sometime in the next 12 months, we'd be reaching those numbers where we might start completing what we call NC wells or adding drilling rigs back. That, of course, hasn't panned out. The rig count today, 74. In June, it was 78. In July, it was 73, so it's pretty stable. But there's some real cause for concern with North Dakota Sweet hitting 28.50 today. Those kind of numbers can't last at those price points. And so either we're going to have to see some better prices, or we're going to see some further contraction in terms of oil and gas activity. The other thing that's interesting about heat and weather and that sort of thing really is that in weather like this, there are a new set of road restrictions that come in. North Dakota DOT will not issue overweight permits for asphalt roads if the daytime temperature gets over 85 degrees. And so we're seeing some lengthy periods of that. And there's even some concern with some of the paved county roads. So there's a little bit of road restriction activity going on that's going to impact August numbers when that comes around. We estimate 848 wells in the NC or waiting on completion category at the end of June. That's down substantially from the end of May number. And so companies were very aggressive with completing wells. As you remember, June was really our peak month, where we went into June with 127 wells in that category. 107 of those got completed. 20 people got NOV or notice of violation letters, and they're in the process of completing the wells or TAing the wells. In July, there were only 10 that hit that 1-year deadline, and 4 of those got completed. 3 of them were temporarily abandoned, which extends that status for a year, and 3 are getting letters, so a very small number. August has the same number, only 10. Our next peak comes in December, January, February, and March. 99 in December, 104 in January, 121 in February, and 93 in March. So we're going to see right around the end of the year another time period where there's going to be a lot of pressure to complete wells. And so we hope that will help companies to sustain production at the levels that we're seeing today. In July, it looks like, or in June certainly, production exceeded the revenue forecast, as did the price. Production was 10% above revenue forecast, and price was 22% above revenue forecast. So we're going to end the biennium on a real positive, but that's fading. In July, we don't know what the production is yet. We think it'll be above forecast. Price was probably about 3% above forecast, but in August, that's disappearing. August oil prices right now are running 12% below forecast. So it's doubtful that production is going to be able to make up all of that. And we may see a little bit of or at least a month right now that's below revenue forecast. I think the other thing I wanted to touch on was what I call the federal fire hose. The rules are just being rolled out in a non-stop manner almost. As you know, North Dakota intervened in the lawsuit on the hydraulic fracturing rule from the Bureau of Land Management. Sometime in early September, we'll hear about preliminary injunction there. BLM just rolled out this week another new rule, a change to onshore order number 3, and this one even has potentially more significant consequences. Under this rule, any well within a BLM communitized area, basically within a North Dakota spacing unit, whether it's private, state, or federal, would have to get a federal APD. So 2,832 of our spacing units now, every well in that spacing unit would have to go through the federal APD process, which is about 6 times as long as the North Dakota process. And so some real concerns about that. I haven't had a chance to visit with my bosses, the policy makers on this yet, to come up with a recommendation of whether the Industrial Commission is going to try to intervene, or I'm certain that we'll be submitting comments. We're also seeing EPA action in a couple of areas, waters of the U.S. and activity on the fugitive methane emissions front. And so a lot going on from the federal standpoint, and none of those are positives for North Dakota production. So with that, I'll stop talking and we'll take questions for a while.
Okay, obviously the big question everyone wants to know is about price and production. If you combine North Dakota, Montana, and South Dakota, it's about 1.3 million barrels per day. Production increases will probably push prices lower, but some analysts are seeing overall U.S. production falling by September. What impacts do you see on pricing?
Well, what we're observing is operators or U.S. oil and gas producers are not indicating any decrease in U.S. oil production. Even as the price has dropped, they have found ways to cut costs, to be a lot more efficient with their drilling and their completion, and they built up a very large number of non-completed wells. We think that the number in the Eagle Ford is almost double what it is in the Bakken, and that the number in the Permian is about equal to what it is in the Bakken. So with a relatively small capital investment, operators are able to maintain production. And you know, we've kind of run the numbers in the North Dakota model at our present rig count, and with our 828, I think it is, or 848 non-completed wells, we could sustain 1.2 million barrels a day for 2 years. So even though we have the low prices, we're not seeing the drop in production that some people thought OPEC was trying to achieve. It would appear that OPEC's efforts are geared more towards other competitors like Russia and Iran. And so we think that we're in a period of sustained low prices. It could last 2 years. The capacity is there to maintain North Dakota production for a full 2 years, even at these sustained low prices. And so it's going to be a long, difficult period.
Are we kind of on an island in terms of having the ability to change or affect any of this? Is there anything that can happen here that could expedite change? Has that been talked about?
Yeah, the question was, are we kind of an island, and is there anything that can happen in North Dakota that would change the world market or change the whole paradigm going forward? The obvious big one would be the ability to export U.S. crude oil. As it stands right now, that looks like it would result in an $8 to $10 price increase for mid-continent producers like us, and that would change things dramatically. I think there's a lot of pressure building to grant that. The U.S. refineries that prefer light sweet crude oil have basically all they need, and so the market expansion is overseas. So there's a lot of pressure building to allow U.S. crude oil to be exported, and that would be the game changer that could really make a difference. We've been working with a young fellow who's here in North Dakota on a Dukakis fellowship, and he's been looking at whether Bakken appears to be more of a swing producer than other plays, and the statistics, the numbers would say no, based on our break-even prices, and even with that price differential, the Bakken doesn't appear like it's going to end up the swing producer. Our op costs or finding and development costs are pretty average for worldwide, maybe even on the low side.
Well, you said the magic word, because that's coming next. Break-even prices. Can they go lower? Is there a break-even bottom?
Well, we're going to be publishing a new set. I think we'll be putting them up on the website later today. We've recalculated the break-even prices for June, because that's the end of a quarter. And our break-even prices in North Dakota actually appear to jump a little bit. The last year's production, and we just use a 1-year average production to calculate those. And even with the decrease in well costs, those break-even prices county by county have gone up a couple of dollars. So I know there's a lot of effort on the part of the oil and gas industry to reduce those break-even costs and to continue to drive well costs down. And there's been some real success there. I think the average well cost has gone from over $9 million to a little bit less than $8 million. But you know, there's a limit to that as well. So. And
this question probably plays right into that too. With changes in drilling and completion technology, how does that impact production, and how much of a role will this sustain the industry in a low price environment?
Well, it's been very beneficial, the changes in completion in particular, where they've gone to the high volume, high sand content hydraulic fracturing jobs. We've seen initial production rates and ultimate recoveries increase by 20% or so. And that has allowed operators to work in the core area in a really positive way. It's stabilized our rig count in the mid-70s. And hopefully, over the long term, it will push those break-even prices down a few dollars.
The break-evens, I'm sorry, Emily.
Yeah, go for it.
When you calculate those and think about those, are those a factor in terms of a well that's already producing? And would there be if it got below that, would they stop drilling from those wells, or is it a startup kind of, when they look at it, do they say, oh, it's not going to make sense to complete this well because of this?
I understand.
Okay.
So the question was, the break-even price that we calculate, what does it mean? I mean, in terms of oil and gas activity, is it a break-even to spud a brand new well? Is it a break-even to mobilize a hydraulic fracturing crew and actually go ahead and frack the well and bring it on, or would it mean shutting a well in and stopping production? And the number that we've been publishing is for spudding a brand new well. It yields a 10 to 20% discounted rate of return on a brand new well with the full investment of $8 million. And so that's what it represents. Is it would still be attractive at that price to spud a brand new well and mobilize a drilling rig. So when you look at that, the break-even cost to go out and do a hydraulic fracturing job is probably around 60% of that, because that's what the frac costs are these days, is about 60% of the cost of a complete well. The operating costs across North Dakota are in the $12 per barrel range. So wells are not going to be shut in unless there's a severe mechanical problem with the well or prices drop significantly further, more than 50% from where they are.
So I wanted to ask about some of the federal fire hose that you mentioned. Could you just explain a little bit more about what Onshore Order 3 is currently and what the changes would mean?
Yes, the question was about federal rule changes and Onshore Order number 3. Onshore Order number 3 right now deals with oil and gas measurement and commingling on federal units or federal, what they call a communitized area, which in North Dakota, they typically adopt our spacing unit as the communitized area for a well. Some places, and communitized areas go back to vertical well technology, and it was a complicated calculation to come up with those. I used to do it. Even the words are complicated. We used circumferential tangential math to calculate a communitized area. So there's one for you. Circumferential tangential. But all that aside, in North Dakota, it's typically a 1280 spacing unit is the communitized area. Up until this rule change, Onshore Order number 3 just dealt with how is the oil within that spacing unit going to be mixed together and measured for sale? How can it be allocated properly to the federal mineral ownership in that spacing unit? The really significant change that's happening with this proposed final rule revision is the requirement now that every well within that spacing unit, if there's even 1 acre of federal minerals in that spacing unit, will have to get a federal APD.
And that's not the case.
And that is not the case today. Today, only if the wellbore actually drills into that federal acre or into that federal ownership is a federal drilling permit required. This rule change would require every single well, regardless of how small the federal ownership was in that spacing unit, to get that federal APD. It is an enormous change in the way things are done in North Dakota. And as we've talked about in North Dakota, it's very common to have federal ownership of 25% or less minerals in a spacing unit and no federal surface ownership at all. And that is a result of the depression of the dirty 30s and lots of bankruptcies on homesteads.
Okay, Ricky.
Sorry.
What's the impact then? Is it time? Is it, what's the big effect about having to go through that APD process?
Predominantly, it's going to be time.
Okay. And do they have to stop doing anything during that process? Or?
Right. They're not allowed to build a location. They're not allowed to any kind of activity until they have that federal permit in hand. So we have done a spatial query on North Dakota spacing units. There are roughly 8,500 spacing units in the Bakken and Three Forks. 2,832 of those contain some federal minerals. Up to this point, it looked like maybe a fourth of the wells in that spacing unit might require a federal drilling permit. With this rule change, all the wells in that spacing unit will require a federal drilling permit. So it will probably increase the number of federal permit requirements by 4-fold or more. And the difference is a state permit takes approximately 40 days to get in today's world. A federal permit takes 290. And it also brings in NEPA and all of the other actions that go with a federal permit. So there will be archaeological reviews, biology, botany, and those things are very seasonal. So the 290 days is a little bit deceiving, because if you happen to miss the season for, say, the prairie fringed orchid, then you wait till next year to do the botany survey. So it can delay it a year and 290 days.
Okay, if we don't have any more on that topic, I got something else. Pretty relevant question with the dramatic fall-off in drilling and some production. Do you anticipate not hiring as many of the new employees that you were authorized by the legislature?
That's a good question, and absolutely, the first trigger for additional field inspectors is 140 drilling rigs. And we're now looking at the projections and thinking it's unlikely we'll get to that before the end of the biennium. So as you recall, there were 22 total in the package, and five of those were dependent on an increasing rig count. So we're likely to end up hiring 17 instead of 22.
Okay, next question. It disappeared. There's a question about CHS dropping the fertilizer plant. Any thoughts on opportunities for marketing North Dakota's natural gas now that CHS has dropped their plans for the fertilizer project in Spiritwood?
Yeah, that's another good question. We've just begun analyzing the impacts of that. It is obviously not going to be good in terms of natural gas capture and processing and transportation in and out of the state. So it's a pretty serious blow. We're still hopeful that the one in Grand Forks will go through, but one of the things that we were looking to for demand for North Dakota gas was the potential for some gas-fired generation in the eastern part of the state. And that depended on getting the transmission lines at least to Spiritwood, which then it wasn't a far reach to build them further east and put in some gas-fired generation in the eastern part of the state for one of our big Minnesota utilities. So it has ramifications in several areas, and obviously not good news. But we haven't really fully analyzed the impacts yet. I can tell you that they're negative, though.
With our outlook for stable production over the next couple of years, how does that match up with other reports like EIA saying U.S. production will taper off?
Yeah, I think there's some conflict there, and EIA as well as OPEC have consistently underestimated the resiliency of the North American shale plays. Not only that, but just how much production was going to come from them, and then how resistant to price declines it was going to be. So most of the decline that they projected was supposed to come from Permian and Eagle Ford, not from Bakken. But even at that, when we've had people look, they have as many or more non-completed wells as we do. So it's going to be very resistant to declining prices. Production is.
I had a follow-up on the natural gas question. Do you think there's any opportunities for Bakken gas under the Clean Power Plan, which will probably increase the use of natural gas and power plants?
Yeah, the question was, does the Clean Power Plan create opportunities for Bakken gas? And I would have to say yes. As we move into a world where there's a shift away from coal, that should create some opportunities for processed Bakken gas to find a utility use, and perhaps it will relieve some of that the problem that we have with now not building the fertilizer plant. So I think yes, I think it'll create some new opportunities. Again, we're really just beginning to evaluate that, and that'll be a big part of the work I think that Mr. Kringstad's going to do towards the end of the year on updating the Bentech study on North Dakota gas production and gas opportunities.
Go ahead, Mary Kate. Okay, sorry if this was something that was discussed earlier, but I noticed you mentioned about how many wells are needed to maintain the current production for however many months. Does that require companies to continue to complete those wells as opposed to maybe filing for temporary abandon? And do you think that they would do that over choosing abandoning them? Is that kind of process?
Sure. So the question is about, wells needed to sustain production and temporary abandonment of the wells versus completion of the wells. And we're still in a situation where we need between 110 and 120 wells per month in order to sustain the 1.2 million barrels a day. We have enough wells being drilled and enough NC inventory to do that for 24 months. The question will be whether companies apply to temporary abandon the wells or whether they complete them. There is another set of pressures we haven't really talked about to complete those wells. And so you have to ask the question, why would the state of North Dakota want those wells completed at low oil prices when oil could stay in the ground and we get more revenue later? But there are royalty owners that are concerned about their royalty checks and sustaining that income stream. But even probably a bigger factor are the non-operated working interest owners. There are a lot of people who aren't the operator of the well, but they've invested in the drilling of the well and they've financed that, and now there's no cash flow from it. So we think the pressures of sustaining cash flow, satisfying stockholders, satisfying investors are going to keep companies completing the majority of those wells. Although at these prices, I think June won't be a typical month. We saw, like I said, 107 wells completed, and it looks like 20 that they might want to temporary abandon. So that's 80-20. At 28.50, that might become more like 50-50. But we think the rig count combined with the number of wells in that inventory being completed will be enough.
Thank you. Okay.
I can ask one more.
Yeah. Well, we do.
We got 3 minutes left.
We lost the other
I got
guy.
one question I'm trying to figure out if he wants me to ask it now or later.
It's about waters of the U.S.
Mm-hmm.
How could that impact oil and gas production and development?
That's a great question. Waters of the U.S., how does that impact oil and gas development? We sat down with the State Water Commission or the state engineer and talked about the impacts of the rule. And the expansion of the federal authority to ephemeral streams and tributaries means that almost 100% of the new gas gathering, oil gathering, and saltwater gathering pipelines that are going to be built would have to get a federal permit. So they would cross those drainages out in western North Dakota that connect to drainages that connect to federal waters. And so all of those little streams and drainages and ravines and coulees in western North Dakota now become jurisdictional, have to get a Corps of Engineers permit, go through NEPA, and probably get a 404 permit to build those pipelines. It looks to us like that could cost companies one construction season, basically, in that whole process, which is a 5 to 8 year process. And we've run the numbers out on what the cumulative impact of that is. It could mean 65 to 70 trillion cubic feet of gas gets flared that wouldn't be if we delay all of that and accumulate that over an 8-year period. So it's the construction of gas gathering, oil gathering, and saltwater gathering lines that impacts the oil and gas industry.
Okay, we've got 2 questions left, and where'd it go?
I like that they withdraw their questions.
Yeah, no. Can you maybe explain why break-evens are so low in McKenzie County?
The break-evens in McKenzie County are so low because the typical well in McKenzie County has an initial production rate of over 3,000 barrels a day. And they're also high gas producers. The gas gathering and processing folks have focused on McKenzie County, as you know, with Garden Creek 1, 2, and 3, and Lonesome Creek, and all of the construction there. So you not only have the very high initial production rates, but you also have a very robust gas revenue stream. And that just keeps those break-even costs way down. I think the other thing about it is that the McKenzie County kind of entered this a little bit later than the other counties. So it was very organized in terms of the spacing units and the spacing of the wells. And multi-well pads are really 100% of the development in McKenzie County. So you've got the real estate and the pads set up to drill 16, 18 wells on a pad. So that really lowers investment costs. And the second thing is the IP rates and the gas rates are better than anywhere.
Okay, and last on the webinar, what share of our natural gas was expected to go to CHS for that plant? Do you have that number?
I don't know the answer to that. That's something we can
We'll figure it out, though.
figure it out.
Yep, I have a few people I think we can put in contact with.
So
Justin might know it.
I'm hoping over the next week or so we can, kind of analyze what the impact of all of that is.
All right, and again, I apologize if this is something that was discussed earlier, but if I could just ask you, how big of a role is efficiency playing in making the most of what operators already have to maintain what's happening out there?
Well, efficiency, the question is the role of efficiency and sustaining activity and production. It has played an enormous role. The well costs, like I said, are down about 22% or somewhere in that neighborhood, and they're continuing to drop. So they've found ways to drill with a lot less trucks, and they've moved the wells closer together at the surface so they can cover more wells with a walking rig. Rig count would probably be in the 50s if they hadn't found all those efficiencies.
All right, we'll get Mr. Kringstad up there. Okay, so we can get it. We can get it. Okay, I just want to know we'll send it to him over. We'll find out.
Okay. Well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into some of the production before we get into the transportation dynamics. If you've noticed over the last several months, I was missing the state of Montana. I was having trouble getting some reliable data. I was able to obtain that. And so for those of you who are wondering what was happening on the Montana side of the play, I do have those numbers updated now in the report. But again, the comment earlier, right around that 1.3 roughly million barrels of production per day that's being moved out of the region. For June, there were some shifts as far as how the crude oil was moving out of the region. You'll see a little bit less of a market share on the rail side and some increases then on the pipeline and refining holding steady in June. So again, not a major shift, but noticeable between what we're looking at in previous months. If we look again at page 4 of how that's changed over time, again, taking a look at the purple and the blue line starting to converge as far as market share, really what's been driving that, not only, again, the new refinery, the new pipeline earlier this year, but then also market prices on the dotted line on page 4. So you can see that in the month of June, it was less than $2 spread between WTI and Brent. And so from the marketing side, that tends to drive folks towards the more traditional pipeline markets versus some of those rail destinations. On slide 5, just an update on my estimate for how much is moving out by rail. So not a big volume change between the 2 months of May and June, but again, it's significantly down from what we were seeing in the late 2014 timeframe. This is a new look on page 6. This question, I know over the years since we've been doing these press conferences, I've been asked numerous times about where is North Dakota oil moving when it leaves the state by rail. And so earlier this year, the EIA started doing some analysis had some access to some data, and they started posting destinations and rail movements in the U.S. And so I processed that data a little bit further and took a look at the market share of North Dakota or PAD 2 shipments by rail. And so you'll see that, again, in the earlier time periods, we were shipping mostly to the Cushing area, the Gulf Coast, and that's evolved now to this year with most of the crude by rail movements going to the East Coast, that's in the green line, and then followed up by the West Coast, PAD 5, and then the Gulf in orange as well. So the Gulf's been losing market share for the last couple of years, while the West Coast and definitely the East Coast have been gaining market share. So again, just trying to address that question that we never really had a good answer for. We knew kind of roughly what may be happening, but finally we have some hard numbers to associate with that question. Slide 7, this is just a snapshot from May. This is the most recent of what the prices looked like, and so this starts to put some of those pieces together as to why the crude oil was moving where it was. This is what refiners on average were paying in the different pad locations. So again, you'll see the East Coast, West Coast, and then followed up by the Gulf Coast having some of those higher priced markets relative to the Rockies and the Midwest. And then where we sit today on slide 8, just under $7 spread between Brent and WTI. And so not a big enough price market changes that, when we start to see the July numbers, the August numbers, I'm expecting things to stay pretty similar to what we've got here in June as far as market share percentages. I don't expect any major shifts based on what we've seen in prices the last couple months. And then just for the details on the trucking between U.S. and Canada, excuse me, again, no major shifts and no real things to watch there. On the crude oil, on the natural gas flaring, 18% in the numbers I ran, and again, that blue piece of the pie has continued to shrink. Again, that's the amount of gas being flared from wells that are not connected. And again, that largest challenge of flaring in North Dakota continues to be wells that are connected, but just not enough capacity on either the pipelines, the compression, the plant itself, some issues on the network that are causing that gas to flare. When we look at getting new wells connected, again, staying above the pace of drilling. So that's a positive to making sure those wells are getting connected as timely as possible. And then again, the other side of the pie, that orange piece, making sure the system gets expanded and is able to handle all the gas that's coming. That'll be an ongoing process now for many years to come. So with that, I'd be glad to answer any questions.
In terms of you go first.
I always raise my hand.
I know, it's weird.
I'm always looking down, so
I should just start yelling. Could you explain all the different reasons why crude by rail is down and producers are shifting more using pipelines?
Yep, so let me get back to page 4. So the question was just taking a look at some of the dynamics, what's happening with crude by rail that may be causing the shift. And so the first added this year, we had the Double H pipeline. That's a Highland part. It was Highland, now Kinder Morgan, and then also the Dakota Prairie Refinery. So that was almost 100,000 barrels a day of additional pipe and refining capacity that came on. And then you'll also notice that from the extremes that we saw in the 2011-2012 timeframe with the market spreads, in the recent months, we've seen that narrow to the point where, again, those barrels that are not committed to a pipeline or not committed to a rail that have some of that flexibility, they'll look at the market conditions and then make those decisions on where they're going to move that crude oil. And so when spreads narrow, especially what we saw in June with less than $2 spread between Brent and WTI, that was one of the major reasons why we saw the shift of those barrels that were uncommitted to moving on the pipeline network versus the rail network.
And when you say the spread narrowed, what does that mean?
The difference, so that price point between kind of the global or the Brent oil price that refiners on, say, the East Coast would pay versus what a mid-continent spot market price is, there's a difference. And so on slide 4, that's the dotted line. You'll see that at time periods it was over $20 spread. So there was a $20 incentive to get to the East Coast versus keeping it on the traditional Midwest pipeline network. When that spread narrows, again, they'll take a look at what their transportation costs are, where they can get that barrel and what they're going to receive for it at the other end. And when that spread narrows, we've historically seen that free barrels or uncommitted barrels tend to move on pipelines.
A good piggyback onto that question is on here. So, based on all that, do you anticipate the volumes of crude transported by rail to return to what they were in 2014 over long term?
Over the long term, that's a tough question to answer because there's so many moving parts with production levels and market conditions. So I don't really forecast where I see crude by rail volumes going. In the near term, July, August, I don't expect any real major shifts. But the one thing that's kind of underpinning this is pipeline capacity. So I mentioned earlier the Double H pipeline that went on into service earlier this year. That was the last major pipeline expansion until one of the big 4 projects gets approved and put into service. And those 4 being the Sandpiper project, Dakota Access, Keystone XL is one of those 4, and then the Trans-Canada Upland pipeline. So there are no other refining projects under construction. There's no other pipeline expansions in the works until one of those 4 goes into service. And so if production continues to rise over that time period, we'll likely see most of that growth be met then by crude by rail movements.
Do you have something, Mike?
Well, yeah, and I think you were getting close, but in terms of where it goes, you had those couple slides there. Why do we care? Or do we?
Well, so the question was, why do we care about where the crude by rail is moving? I guess depending upon the audience, some people, crude by rail is crude by rail, but for other people in the industry themselves, just understanding the market dynamics, what's taking place, there's a high level of interest from an industry standpoint, and even from someone not connected with the industry, just trying to better understand what's driving, what's motivating folks to use crude by rail, where is it going, and why. I think just trying to answer some of those questions is important. And
are people working to get it into other places, or does that just naturally evolve?
And so the question was, how do people get it into other places? And so with those additional pipeline projects that I was mentioning, so I guess back to the other question, why this is important, this helps tell the midstream industry where barrels want to go, where are prices and most advantageous to move crude oil. And so that tells someone looking at a new project maybe where their destination, where they should be targeting for a new pipeline project or a new infrastructure project. So if you look at the Upland pipeline, for example, Trans-Canada, if we look at this example, the East Coast is a major destination for crude by rail. The goal of that project is to move Bakken barrels into Canada onto a pipeline system that would transport it all the way to the East Coast on the Atlantic, where it could then become waterborne by barge and move to those same refineries that today are only being serviced by crude by rail access. Okay. And so there's, again, trying to understand the dynamics, how things are moving, and then putting that together for additional projects. And
just a little tidbit of knowledge that what you can't see here is that we get a lot of industry publications or reporters that analyze markets daily. And so for the average North Dakota citizen, maybe they're not as interested, but for those national, worldwide, industry publications, they're very interested in things like this. Okay. Go ahead, Mary Kate.
Oh, if I could ask, you mentioned the word flexible barrels of oil. How is a barrel flexible, and how much oil is kind of considered flexible? I can just kind of drift between these two options.
Yep. So the question was, what uncommitted barrels? How did some of those dynamics work? It's basically impossible to put a hard number on it, but companies will typically have barrels committed some level. Maybe it's 100% of their barrels they commit to a project. Maybe they only commit 50% of their production to a project or a means of transportation. So they'll typically have some barrels that are not committed that they can look at pricing dynamics and put them into different transportation modes, and that spot market is typically what it's called. So.
Thank you.
And you wanted to know how much, though?
Oh.
Are companies choosing like a lot to make more available to be flexible and shift between two?
The question was how much do particular companies have? Each company is going to be different, and those are not disclosed to the public. Each company just has that in their portfolio. I don't know that they're shifting their mindset of whether they want more flexibility. There's risks there that if there's not free space available, then those uncommitted barrels are challenged. And so there's the advantage of having committed barrels, but then there's an advantage to being able to play the market a little bit with some of those uncommitted barrels.
Just about the graph, can you explain some of the dynamics on there? Like, what is going on with the Midwest such that all the crude by rail used to go there, and now very little of it does? And why is the East Coast rising? Let's just explain that a little more.
Yep. So taking a look at slide 6, the question was what some of the dynamics were. The Midwest, if back when crude by rail started, really the pioneer in North Dakota was EOG. And so they had basically the first unit train facility. They also built a sister facility down in Cushing, Oklahoma, which would be captured in that Midwest PAD 2. So they were shipping crude by rail from North Dakota to Cushing. Then if we bump to slide 7, the pricing over the last several years has become disadvantaged to move crude by rail to the Midwest, to Cushing. It was more advantageous to move it to those other market areas. And so that really is why we saw the shifts. And so really what's driving slide 6, those movements, is mostly price driven, but then also infrastructure driven. The East Coast, there was a time period where they had very little unloading capabilities for crude by rail, but then facilities continued to get built out. They increased their ability to unload crude oil, so that helped not only the pricing, but then having the actual infrastructure to meet those needs helped shift some of those barrels to the East Coast. The Gulf Coast, they've got crude production of their own, and so some of the dynamics taking place there, their production has been rising over the last several years with the Eagle Ford and the Permian, and so some of that light sweet market has dissolved a little bit. They're being able to fill that need with their own production. So some of those are the dynamics that are behind that chart.
Do you think the federal crude by rail rules have had any noticeable impact on rail traffic?
At this time, just looking at the volumes, I don't know that I would say that most of the changes we've seen have been market driven rather than regulatory driven at this point.
Okay. If nobody has any further questions, we will call it a director's cut. I will work on getting those break-evens out as quickly as possible, but right now I'm going to go look at a marsupial jaw that is 65 million years old. So do that first, and then I'll get you your break-even prices.
Thank you.
Thanks, everyone.
We're going to go check out Twitchy.